It's tax season and Uncle Sam is calling. Good morning for another Real Talk Rima Live show. And today we do have our CPA, Victor Martinez. Thank you so much, Victor, for joining us in this Friday morning. Gorgeous weather outside. And I know you're a busy man on tax season, so we appreciate you being here.
Thank you very much, Rima. I greatly appreciate the opportunity to share some of my tax knowledge.
Thank you so much. Tell us a little bit about yourself first.
Okay. Well, a little bit about myself. I'm a child of immigrants from Mexico. My entrepreneur spirit started in the, I guess, late 70s. My first entrepreneur adventure came as selling oranges door to door. I would actually get 10 cents for every bag that we sold. And I like to say that we moved on to bigger and better things because then we started selling watermelons. And after that, my parents had this great idea of selling food from a homemade food truck. My dad was very creative and he built his own food truck because he couldn't afford a brand new one. And we were one of the first families to have multiple food trucks here in the San Fernando Valley. And so I've always been that type of person that wanted to work for myself. And let's see, I got my psychology degree.
Wow.
Also an accounting degree. And I worked for somebody else for 5 years and just got tired of them walking in through the door and decided to start my own practice. And since 1998, haven't looked back. And right now I have one of the largest tax preparation firms in the Northeast San Fernando Valley.
That's awesome. That's awesome. Great story. Thank you for sharing. Capital gain, it's a big thing that comes up with us as real estate agents all the time. What is capital gain? When a consumer or a seller has to pay capital gain and on what?
Okay. Well, capital gain is a different type of tax. It's not your ordinary income tax, but a capital gain tax on specific types of sales. It could be from stocks or in this particular case from real estate. Real estate can be taxed in different ways, meaning that it could be short-term, long-term. If it's capital gains because you sold your primary residence, meaning that you just made way too much profit, that it exceeded the Section 121 exclusion, which is $250,000 for a single taxpayer or $500,000 for a married couple. So what rates? It all depends on your income and your filing status. It could be 0, it could be 15, or it could be 20%, depending, again, on your filing status and what other income you have.
So even no matter what, the more income you have, the more capital gain you pay on selling a property?
That's correct. And again, it all depends on whether it's your primary residence or if it's a rental property. That also factors in. Again, going back to primary, if you, let's say, bought a house for $200,000, made improvements on it for $100,000, and 5 years later you sold it for $1 million, there's a $700,000 gain. What's going to be taxable is whatever exceeds that $500,000 exclusion under Internal Revenue Code Section 121.
Okay, so no matter what, if you made so much money, even on your primary residence, you have to pay taxes on it.
There would be a portion that could be taxable, or in a situation where they sell it, let's say at $750,000, but they purchased it at $400,000. There's only a recognized gain of, let's say, $300,000. Then you get to walk away from that sale completely tax-free.
Got it. Okay, let's with the crazy real estate market and everything that's been happening and so much appreciation, what happens if a owner buys a property and a year later makes so much money on it? If it's holding that property for only limited amount of time, is there any rules for that to pay capital gain or to pay any extra taxes since they have not held it for a long time?
Okay, so again, it all depends on whether it's a primary residence or it was an investment property. If it's a primary residence,
primary.
If it was a primary residence and it was held for less than 2 years, then you are subject to capital gain taxes. There could be some exemptions on it. Let's say, for example, the individual the job took him to Texas, so he had to sell. Then we could take an exemption for a portion of that capital gain, and he wouldn't have to pay taxes on the entire amount. If it was a rental, then there's no doubt that he would have to pay capital gain taxes because it was used for business purposes.
Got it. And just to clarify, the capital gain that a consumer has to pay on selling a property is after, let's say they rehabbed it and they spent $200,000, for example, and they bought it for $200,000. So now we are at $400,000. They sold it for $800,000. Now we have that $400,000. Just help me understand the rehab. It's not part of the gain, correct? If of course they have to prove it and have to provide the documents for their CPA person or the taxpayer person.
Yeah, when it comes to a situation like that, when the person definitely knows they want to flip the house, I guess that's the term that's used in real estate, where the person buys a property, their intention is to rehab it, in other words, remodel it for sale as soon as possible. Then you want to make sure that they're tracking all their expenses. And when I mean all their expenses, everything from one nail to the entire roof, to the miles that they use, to the meetings that they have with the realtors, with the investors, with whomever it is that they're meeting with related to that property. You want to make sure that they account for all those expenses so they can have the least amount of recognized gain for capital gain purposes, and ultimately having less capital gain taxes to pay.
How different that is from a primary residence that you did all the rehab and everything and you got so much gain when you sell it?
Well, when it's your primary residence and it actually qualifies for a Section 121 exclusion, meaning that you held it for at least 2 years and you lived in it for at least 2 years, then you can actually take an exclusion of up to $500,000 if the taxpayer is a married taxpayer. And what that means that you can add in all the improvements. So I always recommend for clients to save receipts on everything that they do to their primary residence, so that if they sell it, whether it's a year from now or 10 years from now, they have all those receipts to minimize any potential type of capital gain taxes.
Got it. What if they sell it in less than 2 years?
In less than 2 years,
and they have an exemption of job transfer or something that's significant.
You always want to make sure that you're holding on to all the expenses that you put into it. Anything from a hanging nail, anything from a screen door, sinks, anything you put into that home, make sure you save the receipts. You want to keep as much
Oops. We have technical difficulties here. I guess we lost Victor. Hopefully he'll get back on line soon.
Sorry about
that. There you are. That's okay.
What happened?
That's okay.
Sorry. All right. So what was the last question? I forgot.
We were talking about primary residence selling it in less than 2 years and done so much repairs, and for job transfer, the owners decides to sell it.
Yeah. So again, with that, you always want to make sure you're always keeping all the receipts for any type of landscaping work that you've done. Let's say, for example, they painted the house or they changed the molding. You want to make sure you always keep those receipts, because the more you have, the less possibility of any type of capital gain taxes. And obviously, we always explore any possible exemptions that we can get for the client, whether it's health related, whether it's employment related, anything that is that we can use to lower that capital gain tax.
Okay, and Victor, I hear saving receipts, saving receipts. I've
Yes,
been
very
saving my
important.
receipts for years. They are in boxes. And the other day
Well,
I tried to clean up, and guess what? The receipts are all faded.
you need to scan those receipts. You need to make sure you scan them. The simplest way is maybe just take a picture with your cell phone, send it to your email, and then create a folder that is labeled house receipts or improvement receipts. That's a simple way of doing it. The other thing you can do is store it on your computer, but then also have a backup of that. Because yes, even in regular businesses, we see some clients that get those receipts, especially from the gas station or from the Home Depot, and next thing you know, they're faded. And the IRS will not give you a deduction if that receipt cannot be read.
Oh boy. Okay. And so what when a primary residence becomes a rental, what happens then? Like I bought a house, I lived in it for 5 years. Now I want to move up to a bigger property. I am gonna leave my the one that was at one time primary residence. I'm converting that into a rental, and I'm
Mhm.
moving on to a bigger property. So what happens tax wise? Does that original primary resident becomes 100% investment property? And so can you kind of guide us through that a little bit?
I've had that come up several times with clients that let's say relocate, and their primary residence that now qualifies for an exclusion becomes a rental property. I always let them know that they literally have up to 3 years to sell that property and still get that exclusion. We had a client that came over from another tax office. Um, they were upset. They had to pay, like, I believe it was around $68,000 just to the IRS alone. And what happened is they sold a property that had been converted to a rental property. And we went through the entire worksheet, and we ended up being able to exclude it because the value of the property, when it went up for rent, did not increase by much more than $10,000. So it doesn't matter how much it goes up by, but we then went back and excluded it because it qualified, because it had been used for at least 2 years in the past 5 years as a primary residence. So again, the fact that the value did not go up by too much, it allowed them to take a full deduction on it, and they did not have to pay those $68,000. Now, the bad thing was that the next year they still went back to that same person who couldn't help them out, and then they came back again.
So so as long as it's within 3 years, they're going to be exempt from that taxes.
They can take the exclusion on the value on the sale from the date they converted into a rental property. If there's any gain from the time they converted it to the time they sell it, that gets separated, and they'll pay capital gain taxes on that portion only.
Got it. Okay, and what happens to the same exemption happens with their new property now when they sell it in the future?
Yes, they can take that exemptions. You can take as many exemptions as possible, so long as you aren't taking rental properties and converting them into uh, primary residence, or playing the game of, okay, you know what, I'm going to go live in this rental property and make it a primary residence for 2 years and sell it. The IRS will catch on to that. But if you legitimately go from one property to another, and you just say, hey, you know what, I don't want to live here anymore, and you sell it, as long as you actually live there, you're good to go.
Okay. And what if I bought a property within the 3 years, I decided to go back to sell the one that I just bought and go back to the rental that's now a rental?
If it had been your primary residence, became a rental property, and then you go back to it, you want to make sure you account for that time period, and was there any gain. You want to always make sure you identify that gain, so that if you ever sell it in the future, the IRS does not come back and try to tax you on it, as long as you've qualified that property. So, but you always want to make sure, hey, how much did that gain, how much of a gain did I have between the time that I left and came back to it? And we'll recognize that as a gain, so that way the IRS doesn't try to reverse the entire exclusion and then have you pay capital gain taxes on the entire exclusion.
Got it. And how would a consumer get away from paying capital gain?
How can a consumer get away from paying a capital gain? Number one, documentation. You always want to make sure that you document everything when it comes to real estate. Obviously, expenses, the time period that you were using a property as a primary residence. If it had always been a rental property, unless you sell it for a loss, it's pretty much guaranteed that you will have to pay some sort of capital gain tax.
And I know you're familiar with the 1031 exchange. Do you do them yourself, or do you refer that for somebody who wants to exchange? Do you refer them?
No, I do report the sale of 1031 on their tax returns, but as far as the actual escrow process, that's obviously with a 1031 facilitator. So if you have an escrow company that does that, that's what we would refer it to.
Got it.
The tax reporting part of it, we take care of that.
Perfect, perfect. And going back to that 593 form, like I always tell my clients to refer to their CPA to fill it out the right way. There is one in there that's not, which is number 3. The seller has loss or zero gain of the California income tax purpose on this sale. And what does qualify a property to a loss or zero gain, other than being a primary residence?
In that particular case, you really have to go back through all your expenses. You look at what was the purchase price, what was involved in the cost of that purchase, what improvements have you done from the time that you purchased it to the time you're selling. Other expenses that are going to be included is the actual expense of the sale, which means realtor fees, title, all of that. So you want to get as much information as possible. With some clients who didn't keep records, I say, okay, go through your family pictures. Go through your family pictures and identify the different improvements you've done throughout the years, and then just kind of do some recollection. Remember how much it might have cost you, because you want to be able to prove to the IRS, hey, this house was like this. I made these improvements. These are the costs that I incurred. So what's my recognized gain for tax purposes? So anything that helps you identify the different improvements will be very helpful when it comes to your taxes. And obviously you want to minimize your capital gain taxes.
What would you see the biggest mistake a consumer do that costs them, when they sell a property, that costs them so much money when they come to file their taxes? Especially now, like with real estate, we have so much appreciation. Sellers are making so much money, and from one year to another, it's like, as you know, real estate have gone up so high, and we are having like a lot of questions when it comes to the closing table. So what do you see the biggest mistakes sellers are doing when they're coming to you when they're filing their taxes? Because again, the consumer doesn't always ask their CPA ahead of time. They come back when there is problem or there is trouble, or at the end when probably you cannot help them.
The biggest mistake is not consulting with me before they actually sign the contract, or even after they sign the contract, they don't consult with me in regards to what tax implications does that sale have. So it's always great to have a three-way conversation between the realtor, myself, and the client, so the client understands what's going on. As a realtor, definitely great if you can get the sale, but you always want to make sure that it's in the best interest of the client. You want to make sure that the client fully understands what's going on, what tax implications that sale is going to have, because at the end of the day, it's one of those things that how much tax are they going to pay? Is it going to be something that gets them upset? So you want to make sure that, hey, tax is as easy as possible. But again, communication is key to it here.
Perfect. Let's go now more of the realtors' expenses, because I know a lot of realtors watching us today and they care about this subject as well.
Yes.
In our world, we have so much expenses, and sometimes it's confusing what's deductible, what's not deductible. Like in the past, client's gift was $25. Like, what does $25 get you? I believe they have raised it a little bit now. But what is a deductible standard for closing gift, for example?
Okay. Um, without having to give any type of forms to the client, it has to stay under $600, because anytime you spend $600 or more, you have to give what's called a 1099. So if you give a prize, if you give an award, it has to stay under $600 so that you don't have to issue a 1099. And going back to what you asked earlier, is like, what can you deduct? My simplest way of answering the question is whatever's reasonable and necessary for you to conduct business. If you have, let's say, luncheons and you invite prospective clients, um, and your prospective clients are looking to buy in more affluent areas, then a dinner at a five-star restaurant is going to be more appropriate, rather than to some clients that are going to be buying, let's say, in less desirable areas that are not as expensive. The type of car you drive has a big role in it. If your clients expect you to drive up in a Mercedes Benz compared to a, let's say, Toyota or Honda, it's reasonable and necessary for you to have a Mercedes, because then your clients feel more comfortable with doing business with you. And unfortunately, that's just the way it is. Appearances do sell the product, and if you need to spend that extra money on a more luxurious car, and it's getting you the sales, then why not? And the most important thing is, again, documentation. Document everything you do within your business.
And speaking of luxury cars, leasing versus buying.
Okay. Regardless of which you take, it all comes back to mileage. And the best way to keep track of your miles is make sure that your phone has an app that tracks your miles. At the end of the trip, you write in on that trip what that trip was for. Okay. So you make sure that you document all the miles, because that's what's going to determine what percentage of your vehicle expenses are going to be deductible. No one outside of a diesel truck, one of those that carries those trailers, can deduct 100% unless it's a vehicle that is used exclusively for your business. So say, for example, you have a car that you leave at your office and it stays there 24/7, and that's the car that you use while you're at work, then that one will be 100% deductible, because when you go home in your other vehicle. But when you're at the office, you pick up clients in that car, you take them to the showings, you whatever it is that you do at that business in that vehicle, then that would make it 100% deductible. The moment you take it home, the moment you stop at the grocery store, the moment you stop for dinner, then it becomes less than 100% deductible, irregardless if it's lease or purchase. So miles need to be documented.
So basically, the miles is the most important thing. It doesn't matter if it's a lease or it's a purchase.
Correct. So
and
once
you don't deduct them any differently.
No, once you determine which method you want to use, the miles are going to determine how much you can deduct. And what I mean by method is you either do actual expense based on miles or standard mileage rate based on miles. Okay, so the IRS gives you a certain amount of cents per mile. It's at 55 cents a mile for you to deduct just the miles. But then you say, hey, you know what? Maybe my Porsche, since I pay $1,200 a month, I can get a bigger deduction that way. We go back to the miles. Let's say you drove your vehicle 18,000 miles for the year. And of those 18,000 miles, let's say 17,000 miles were just for business alone. And you documented it so great that, yes, you can take the majority of those expenses, meaning the majority of the car payment, the gas, the maintenance, anything you put on that vehicle, whether it's a wrap or whether it's anything that will promote your business. So then you get to take more of those actual deductions rather than just the miles.
Got it. And what other, like with the businesses, what other things that can be deductible?
Well, again, it all depends on the type of business. They all differ from one thing to another. But in real estate, essentially, you can take all the deductions for all your dues. You can take deductions for Right now, you actually can take deductions 100% for restaurants. Okay, why? Because the IRS says, hey, the restaurants have suffered quite a bit in the last year or so. We want to encourage people to go to restaurants. So now you can take 100% deduction for restaurants, whereas before it was only 50%. So
Wow, that's good to
2021,
know.
yes, 2021 and 2022, you can definitely take 100%. But again, that's if you're taking clients to lunch or early dinner. Just document who you took and what the purpose was. Because let's say, for example, if you take one client a month, no problem. But what if you take the same client month after month after month? Is that a client or is it a friend? So document it so that you don't have any issues with your deductions.
Well, that's new to me. I didn't know that now restaurants are 100% deductible. Thank you for sharing that.
That's 2021 and 2022. So we'll see what they say after 2022, because some of these deductions or credits only apply for a certain number of years.
Okay, and now speaking of COVID and speaking what's been happening, in our country, is there any reliefs, anything that kind of like relieve the consumer from any like further deductions on their taxes, or more of an extension if somebody, they're not ready to file right away? Can you collaborate a little bit on that?
Yeah, definitely. Well, what's already happened is this. Instead of April 15th being your deadline, it got extended to May 17th. So you have an extra 32 days to file your tax returns for the year 2020. The other thing
that's for corporation as well, or just individual?
No, that's individual.
Okay.
S corporations were due March 15th. C corporations were due April 15th, so yesterday. If you're a single member LLC, that goes on your personal tax return, so you have until May 17th. One of the things that happened is that if you were collecting unemployment, and this past year or through this pandemic, self-employed individuals were entitled to EDD benefits. That's unemployment benefits. The first $10,200 is excludable from any tax, which means if you collected $9,000, guess what? You don't pay any tax on that amount. If you collected $20,000, then $9,800 will be taxable. Other things that have been available for realtors has been PPP loans. If you file a Schedule C, you were able to obtain a PPP loan. If you didn't take the first draw, you should be able to take a draw now. And now they're using actually the gross amounts in order to determine how much they can give you. So where before it was based on your net income, so you weren't getting too much from it. The other thing that's happening is EIDL, Economic Injury Disaster Loans, through the SBA. If you qualify, it can be up to $500,000 that you can get, and the interest rate's at 3.75%. There's some restrictions as to what you can use it for, so just be very careful, read the fine print, because otherwise they may ask for that money back immediately.
Yeah. Speaking of the PPP, I know a lot of people, they are getting still the unemployment. Some of people are coming off because they're going back to work. Would that affect that in any way, or that's still the 10,200 applies?
The unemployment, yes, the 10,200 still applies. However, there is an income limit of 150,000, meaning that your overall income has to be less than that in order for you to take that exclusion.
Oh, so if your income increases that, you're not, that goes away.
Well, that exclusion was for 2020 income. There has been no ruling on 2021 as of yet. But obviously, if there is a ruling, I'm pretty sure it's going to be very similar.
Wow. Victor, is there anything else you'd like to share with us? Any new rules, new regulations, new things that's happening that the consumer needs to be aware of? I know, like we mentioned, it's tax season is approaching, and any tips?
Well, one of the things I want to mention, especially for all your clients, that are buying homes, solar panels this year still at 26%, which means that if you buy a solar panel system and it costs you, let's say, $20,000, you can get a 26% tax credit directly on your tax return, which means it lowers your tax liability. And if you paid in enough federal income tax, you'll get some of that money back. So it helps with your tax liability. So
speaking of solar panel, because I know there's a lot of different contracts for solar. You can buy it, you can lease it. There's companies that they can put it on your roof, and you pay as much as you generate electricity. So is that any different in the rule of the credit?
You have to purchase it. You cannot lease it. So just read the fine print. Make sure you're buying the equipment. Make sure you read the fine print as far as who gets the credit, because I've seen some solar companies say, okay, well, I will give you a 3% interest rate, but you got to give me the tax credit. If not, your interest rate's going to be at 10%. Which is unfair to the buyer. You want to make sure you get a solar company that you can trust. Maybe you can, maybe for your next webinar, you can talk about or invite some of these solar panel companies so that we can get some good people that are really going to be looking out for the best interests of the clients.
Right. So leasing a solar will not help you on taxes.
No, it does not.
Okay, good to know. Anything else you'd like to share?
That's pretty much it. I mean, everybody has a unique situation. So if you have any questions, feel free to send me a text message, reach out to me on social media, or give me a call. If you want to search for me, just search the hashtag #DoMyTaxesVictor. Again, my hashtag is #DoMyTaxesVictor. You'll find all my social media as well as
super
my
easy
contact. Yes.
And your phone number, Victor?
My phone number is 818-361-1668.
Awesome. Well, thank you so much for joining us this Friday.
Thank you.
I know you're busy and we really appreciate you. And thank you for sharing your info and your contribution. We really appreciate you. Thank you.
Thank you.
Have a good weekend.
You too.
Bye-bye.
Bye.